Okay, we're going to start today by looking at the S&P 500, and we're going to look at the 1-year chart. You can see right now we're above all of our moving averages except, yeah, about all of them, the 50-day moving average, the 100-day, 150-day, and the 200-day. So that's a good sign of momentum in the stock market. And you can see from our stochastics that we're 52. That's halfway between overbought and oversold. So we're in the middle of nowhere. So we have to look at our, see, hold on. We have to look at our calendar to see if there's any season, anything going on in general. So right now we have a holiday. So people are really, stock market usually goes up around holidays. So we have, this week we have earnings coming out, and next week the tech earnings, next 2 weeks. So we're going to have a lot of earnings coming out. That's a good indication. If we were to guess if it's going up or down from a halfway oversold, overbought state, we would guess that it's going higher, um, because earnings a lot of times kicks stocks into gear and makes them go higher. So after earnings are out, February is usually pretty um, subpar month of the year. So if we look at our calendar, after we get off January, February is one of the worst months of the year, seasonality wise. So that's the setup for where we're at right now. Let's look at some of our talking points. First of all, we're finishing up some earnings of some companies this week, but next week we're going to have Apple, Google, Amazon, Netflix, a lot of the big stock companies. And we're going to get some, we have the inauguration today also. And there could be a lot of directives by the new president that could cause stocks to go up or down. All right, so now we're going to look at some of our numbers. The S&P went up 2.5% in the past week. So we have 58% of the stocks over the 200-day moving average, and that we are gaining momentum. The other things to think about are, the 10-year and the 2-year are down 3%, 0.5% since last week. So we do have that inverse correlation we talk about every week. Let's look at it. The S&P is the purple line. You can see it's going up while the 10-year is going down. So just to review, the 10-year Treasury, the higher it goes, the lower the S&P 500 goes. And it's kind of working that way because people don't want to take risk. People would rather buy a short thing Treasury if it will yield more than the possibility of a stock in the stock market. All right, so let's look at other things we have to talk about. All right, yes, we are around 52 right now. That's halfway between overbought and oversold. So that's no indication to buy or sell right now. And we have price of oil is going up just a little bit, 1%. We have a lot of geopolitical issues that could cause that to happen right now. And we have the dollar is unchanged. That's good. We don't want it to go up. We like to have it go down if possible for the stock market. Inflation is unchanged at 2.7%. Gold is up 2.5%. And you can see the dollar is flat this week, but it's in an uptrend. And that's not good for the multinational stocks. You'll know in the next 2 weeks, there's going to be a lot of companies saying that currency is a headwind for their earnings. So they're going to earn a little bit less on the money they make overseas. And fear and greed index, people are getting less fearful. Last week we were near the extreme fear. Now we were at fear 27, which is around right here, and now we're less fearful. So people are getting more comfortable with the new administration, the new changes in the new year. Um, the opposite side, we have the Amateur Association of Individual Investors survey saying that the majority are bearish. So that's a contrary indicator. So right now we have, mm, whenever the amateur investors are bearish, that's the time to hold your nose and buy and don't sell. So that's keep that in mind. Um, the VIX is at a low. So right now it's at 16. It was at 19 last week. So people are getting more comfortable and not as fearful. That's what that's saying. And if we look at our emotional chart, we're in a position where people are kind of returning to the normal. Um, we're not necessarily truly fearful yet. We're getting less fearful and we're hoping to return to a normal. Um, so just to review some of the basic emotions in investing, whenever stocks are going up, you get enthusiasm. You have people on TV talking about the stocks going up and people get greedy and then they get delusional. Um, last year we had an AI paradigm where all the AI stocks were going up and they couldn't go down. Um, now we're in a fearful stage where people are second guessing whether the AI trade can happen and whether the tech stocks will continue to go up. We haven't had capitulation in like 2 years. So we'll address that when it comes. But right now we're kind of trying to get back to normal. And let me see. I guess the big things that we have to worry about that might lead to a crash, random Trump actions or words. Right now we have 4 years of extreme volatility. We don't know what's going to happen every day with the president. We've had 4 years of stability. Actually, not a lot of laws passed with the Joe Biden administration. Now um, we have changes. We have possible tariffs. We have things that could affect the stocks we're watching. So we'll just have to deal with that as it comes. Right. So PE ratio for the S&P 500 now is 24.79, according to Wall Street Journal. That's historically very high. So the average PE for the stock for the S&P is 15. So that's 35% less than we're at right now. So don't be surprised if we correct in the stock market 20% or so. That will get us more towards a 17 PE. That's all part of investing. You got to deal with the ups and downs. Okay, we're doing our first to worst and see what stocks last year that did bad might do good this year. So we can see energy is one of the top performers this year. Um, you can see the energy sector is up 9%, materials up 5%, industrials, utilities, financials. And look what's on the bottom, the IT sector, which is flat for the year, and the real estate and healthcare. Okay, so the energy, which was the worst from one of the worst of last year, is turning out to be one of the best this year. And you see, so we're going to keep our eyes on this energy sector because we know the new administration is going to help that the oil companies succeed. And let's look at the oil stochastics for this week, the energy stochastics. We're looking for XLE. There it is. You can see we've been in a sideways pattern for over a year. And my guess is we're gonna break out of this sideways pattern and we're gonna form a new uptrend. And we're overbought right now, but we'll go over a little bit later some of the. Well, we'll go over that right now. We did a stock screen for this week, and what I did was I listed all of the energy stocks, and the energy stocks are in orange, See, a lot of times whenever you're looking for the next sector to go up, you look at you do a screen and you see some of the sectors um, that the top stocks are in. So we have a good 8, 9 stocks out of these that are energy. So these are orange. So energy transfer, energy product partners, Phillips 66. Okay, so we have stocks that are listed as quality stocks that are kind of on sale. Um, and other sectors here that fell into our screen are the bank stocks. You can see all the green stocks that are highlighted are bank stocks. So that's why I would think the banks and the energy could be good sectors going forward. We don't have a whole lot of um, drug stocks in the top um, in our stock screen. So, okay, all this being said, we're going to go back to, we're going to look at a couple more things. Okay, we're going to look at the sectors of the stock market in a Trump presidency. So we know the financials and the energy sector were listed as stocks at the energy that could be, these are sectors that could do well in the Trump presidency. So we're gonna focus a little bit today on on those sectors. Let's look at little note from Ben Carlson from CFA. He mentioned the best performing S&P 500 sectors for the past 10 years. And technology was up 20% per year on average for the last 10 years. The worst performing has been energy. So if you look, we've been tracking energy has been doing really bad for the past 2 years anyway, right? Um, and we have a lot of reasons that this year energy can be doing better. So anyway, he mentioned that I happen to have most of my portfolio in technology. One thing Ben Carlson cautioned was, it doesn't work like that forever. So if we look at the worst performing sector for the year 2000, we had two different asset quotes here. We have one from 2000 to 2010, 10 years. Um, the technology sector did the worst. You can see large cap tech, large cap did the worst actually during that time, and REITs did the best. So although right now large cap tech is doing the best, that doesn't mean the next 10 years it's going to be the same way. So you have to be diversified. That's why you look at these asset quilts. Okay, so he said energy was the worst performing sector for the last 10 years. Ben Carlson thinks the next 10 years are going to be totally different than the last 10 years. So he has this little thoughts on sector picking versus owning the index. So anyway, his point is that in the year 2000 to 2010, you had a totally different sector, REITs, outperforming. And large cap and tech stocks aren't going to outperform probably for the next 10 years. So you have to diversify and keep a diversified portfolio. I thought that was an interesting thing to go into. Okay, let's go into some of the market movers. Right now, let's look at the US 10-year. Okay, it started going up here recently. It's been going down all week, and today went up a little bit. So sectors going up and down the most. We have semiconductors, oil, technology, and banking. And the bank, okay, we can tell the banks will be doing well because the new administration is going to be nice to the banks and regional banks. So we have a lot of that. why the semiconductors are going up. Let's look at the top 10 movers to say we have some possible takeover activity with Intel. And a lot of times, whenever one company is in the top 10 for exciting news like a takeover, the whole sector goes up. And the other top, we have in our top gainers, we have SLB, which is a oil refining company. We have Truist, which is a financial company. So we have a lot of, this is power company, utilities, and the iron company, they make tractors. So we have a good portion of, mm, okay, so we have that theme of financials, energy, and um, financials, energy in our top, and Palantir and AI basically at our top holdings here, top 10. And top decliners, we see Eli Lilly, a drug stock, another drug stock, a lot of drug stocks in there. Zoetis, these are all drug stocks. So half of these are drug stocks that are in down today. Um, okay, Vistra Corp, they do power center, data center development. Apache is a oil company. All right, so that was a good little excursion, but I think the semiconductors are up today because Intel got a bid for a possible takeover. Rumors, it's all rumors right now. And oil is up primarily because, let's see, no, look at that. The price of oil is down a little bit. So I'm not sure why oil is up. Okay, so, okay, a lot of these, most of these are sectors that will do good in a Trump presidency that we've already talked about. And healthcare is kind of, my guess is the whole sector has been down because the new Trump administration has RFK Jr., which might disrupt their business models with because just because of that, it's and Trump is going to be taking over on Monday. There's could be some fear. And biotech, okay. So that was good excursion. Okay. Next thing we can talk about. Let's go back to Dan Niles picks from this year. This is a very small company, ADTN. It was as soon as mentioned it on TV, it went up 20%. So Cisco is up only 1.74%. IJJ is the mid cap ETF. It's up 3.55%. That's really good. KBWB is up 6.98%. That's the ETF for banks. We're going to look at the top holdings of each of these. Let me see. Hold on. Okay. So the KBWB Invesco Bank ETF. This is one of his top picks for this year. You can see that Bank of America is up almost 6%. Bank of New York, Citigroup is up 13%. So all the banks are rallying basically, and that's due to potential regulation making it easier on the banks for takeovers and IPOs and M&A. So the whole idea of deregulation is really making this company go up a lot. This sector. So the good things about this sector is they have a low PE ratio, average around 15 or lower. They pay a dividend, and they benefit from the new administration. There could be deal making IPOs, takeovers, and they're considered a safe sector. Also, on top of all this, they gave great earnings. And Dan Niles actually said this week he likes this pick even more after the earnings because the earnings and projections are supposed to be really good. So these stocks are off to a good. This pick is off to a really good start. And let's look at the IJJ top holdings. Okay, one of these stocks at the top of this top holding of this whole ETF is UNM. I thought it'd be interesting to go over that and what it's composed of. UNM Group, it's up 4% this year. You can see that all these other ones are up around 4% on average this year. So his idea for this year was they have a decent growth around 12% or more, and return on equity is decent for each of these around 10. They half of them have dividends and low PE ratios. Right now, he thinks that a lot of the high PE ratio stocks, like the Magnificent Seven, aren't going to do as good because the higher the PE ratio, the most of the time, the more volatile it is. Okay, so I did a screen this week and I found that stock Unum in our stock screen. So it says it's around 10% undervalued. The PEG ratio is 0.9. So I thought that was an interesting one to go over, just to research to see if it had any credence. Let's look at Unum. The stock is in an uptrend, you can see. It's overbought right now, 72. It's near the top of its range. So it's not probably not a good time to buy that one. But it's over all of its major moving averages. And so the chart looks good and the fundamentals, we're going to check those out next. Before we dive into this, we just have to see if we were even interested in this industry at all. I went to Yahoo Finance, did a quick understanding of what the stock does. Basically, they do long-term, short-term disability, group life, and accidental death, and dismemberment products. So like an insurance company. And a lot of the insurance sector in general is down quite a bit right now due to the fires in California um, and the problems with the CEO being shot. And so there's a lot of pressure on the industry. So this is a good time to be a contrary investor to possibly look into just a new stock in that industry. So most of their stocks, most of their business is through individual group life insurance. So it's not necessarily casualty or it's not necessarily um, housing or autos. So let's look at some of the numbers for this stock. I looked at the estimated earnings for the next couple of years. Seems like they're growing around 10%. The PE ratio is only 8. So that makes them about 20% undervalued if we're doing some quick math. The market cap is only 13 billion. It's a very small company. Its forward PE is 8, and the profit margin is decent. That's like our minimum at 13, and the return on equity is decent at 17. That's great. So they have maybe 1 billion in debt. So debt minus cash, they have about 1.5 billion in debt out of 13. So that's a tenth of their market cap in debt, which is kind of something to be concerned about. But they're an insurance company, so part of their business is borrowing money. But they do have 1 billion in levered free cash flow, which is decent. And they have a 2% dividend rate, which is decent also. So right now it's looking, you see, it's looking like they're around 20% undervalued, and they could pay a dividend of 2.5%, which is pretty good. In general, it's not exciting enough for me to be interested in it, especially it's run up a little bit right here. But if it went down a little bit, rats. If it went down a little bit, you can see the great thing about this company is it has consistent earnings over time. You can see that straight line up for earnings from 2023 into the future. You don't see a whole lot of red in there. So that's really good. So it's predictable stock. This is the kind of stock that I would watch. It's a smaller stock. So whenever a market sells off, this will go down like 30% because it doesn't have as many people following it. And so, and I'll probably buy it when it gets lower or something like that. But right now it's example of a mid cap that is around 20% undervalued. Um, if I'm buying a smaller stock, I'd rather have it at a discount because it's not as reliable. If we look at if we look at the returns for the past 10 years of the large cap stocks, if you look at this, you can see large cap negative there. They return 20% per year on average. So large caps, at least for the last 10 years, are a bit more reliable than the smaller cap stocks. And in an environment where interest rates are kind of higher, and this company has debt potential. It's kind of risky to buy a stock that has debt, and we're in a higher and higher interest rate environment. So okay, so I just wanted to review again. Don't be surprised if we have a drop in the stock market. So I just mapped it out again. 15% correction. A lot of times, whenever stock markets drop, they drop to a prior level of support. So when you can see right here that is this stock, this S&P chart, we have some support here where it bounced, and it bounced here, and it bounced here. So if the stock market sells off in a major way for whatever reason, a lot of times the stock market goes down to levels of support like that. We have a level of support there, and we have a level of support there. And whenever stock markets sell off, it's just part of investing. You got to be a grown up and not be a nervous Nelly and sell whenever it goes down. That's just something. That's a reminder. There's a stock. There's a talk stock. There's an article I found. Prediction: this stock will be the biggest quantum computing winner of 2025. The one interest, and it's Google actually, according to this article. What I'm going to do is I'm going to look at the pre-market information. These are the most active stocks in the pre-market. We have Rigetti Computing. We have QBTS, Quantum D-Wave. We have Q Quantum Computing. So we have a lot of these quantum stocks. What we found out in the past 2 weeks is there's some major, very smart people, CEOs, saying that quantum computing is not going to be profitable or viable as an industry for at least 15 to 20 years. But there's still an interest in these stocks, primarily because they're trading vehicles. They're not going to have a profit. But the great thing about Google is they're already profitable and they're coming up with some technology that's probably higher quality than everyone else. They have a product that reduces errors as it adds qubits. And as one of the problems with quantum computing is it's kind of unreliable and it has errors. And Google has a way around that. The problem with these other companies, well, I'm going to go over one of them just to show you how dangerous it is to invest in one of these high-flying stocks that very volatile. Look at this chart for Rigetti Computing. It went up, to sky high, and it went down to like $7 a share. It went back up to 21. So this stock right here is Rigetti. You can see that there's zero profits and negative return on equity. They have more cash than debt right now. That's decent. But the problem is, if you look at their earnings, they're projected to lose money at least for the next 3 or 4 years. And they haven't earned a profit in the past couple of years. So most of these quantum computing stocks are not profitable. And the CEO of NVIDIA said that they are not going to be viable as a company for another 10 years or 15 or 20 years. So when you see negative earnings projected, also, you have a possibility of a company going out of business. And especially if they're not going to have profits for another 10 years. But Google has been working on this project since 2012, and they make money and they're profitable and they can fund their development. So that's why this article basically said Google is probably going to be um, the winner of the quantum computing chase. So I thought that was interesting. And there's one more last story I wanted to say. There's a 10 undervalued dividend stocks for 2025. And you can see we're following a lot of these stocks already. Um, and I thought this is Morningstar. They had a nice article. So they're really technical oriented. They know fair values of stocks. They specifically mentioned Kraft Heinz. It trades 45% discount to our intrinsic valuation. So it's half off, according to them. It puts it in a 5-star category. So remember, when you're looking for dividend stocks, they don't necessarily have to be growing fast. They don't have to be 10% per year growing. As long as they have a consistent, steady stream of earnings and that will pay the dividend, and they're increasing their dividend, that's what's important for dividend investing people. So I thought it'd be interesting to look at the earnings projections for this company, Kraft Heinz. Warren Buffett actually owns a big chunk of this company. You can see that their earnings projections aren't very exciting. I'd say they're growing at 4%. So if you can see 2%, 5%, 4%. So let's say 4%. And their dividend is paying 5%, 5.25%. So the total return, if you add 5.25 to this, is 3%, is 9. So let's say the 4P is 9 and their total return is 9. So the PEG ratio is 1. So the total return you'll get per year is 9%, half of that being the dividend. So that means it's around fairly valued. The bad part, the headwinds for this company, a lot of the snack and junk food companies are going down a lot because the GLP-1 drugs might reduce demand for the product. And so this company's Kraft sells a lot of junk food. Half of it maybe is junk food. So the key part of this article for Morningstar was they're looking for a company that has steady earnings. Look how steady even that earning stream is. And the stock is down. You can see this is the perfect chart that Peter Lynch always watched when he was a money manager at Magellan. He likes whenever the chart goes down, but the earnings stay, steady. And he would buy it like right there. And according to Morningstar, it's half off, but it seems like it's just barely valued in my mind. So I thought that was interesting to go over that. We don't go over dividend stocks very often. But you can see the market cap is 35 billion and they have 20 billion, like 19 billion in debt. So that's a good portion of their market cap. So this is a big, over half of their market cap is in debt. So they have to constantly pay off that debt. And as interest rates go up, that's going to make it harder for them to refinance. So that's going to be a big part of their story, how they pay back this debt. They acquired a lot of companies, and that allowed them to grow, but they still have to spend time paying back that money they borrowed. But this 5.5% dividend is really important. And they have 2.5 billion in leverage-free cash flow. So every year they're going to pay a portion of this 20 billion back, 19 billion. So it's a good dividend stock actually. So if you buy it and you hold it, you'll probably won't increase. We won't increase the money. Um, you'll the price of the stock will go up maybe 5%, but you'll get a 5% dividend. So that's a 9% total return, which is pretty decent. That was a good article. And just to review, okay, we're going to have a new presidency with all kind of new directives and things going on every day. So you have to determine whether those news stories affect the stocks that you're watching. And a lot of the stocks we're watching are large enough where they're not affected too much by maybe tariffs or other things that happen with the new administration. So I hope that was useful. I hope you have a good week of investing, and I'll talk to you next time.